Let me start with data. Only data. No opinions, no hype. And very important, I'm not telling you to invest. I'm not telling you to buy. I'm not telling you to sell. I'm only presenting numbers and behavior. You make your own decisions. Here are the first numbers. In the last major volatility cycle, silver moved more than 22% up in under a month. In the correction that followed, silver dropped roughly 11% in less than 10 trading sessions. During a high volatility week, silver's daily range expanded by over 3.5% per session. In one 24-hour futures window, silver moved nearly 5% from low to high. Over the last year, silver's total price, swing from major low to major high, exceeded 40%. During strong bull phases, historically, silver has outpaced gold by 1.5 to 2 times in percentage moves. That is not prediction. That is history. That is data. And when those percentages begin to appear again in short time frames, markets pay attention. Silver volatility has expanded. That is the headline. That is the fact. When volatility expands, price does not move quietly. It moves fast. It moves in bursts. It tests levels. It breaks levels. It comes back to test again. Smart money watches levels, not because they know the future, but because levels show behavior, and behavior shows where orders are sitting. Right now, silver is in a volatility expansion phase. You can measure this. Average daily range is higher than the previous calm period. Intraday candles are larger. Futures volume has increased. Options pricing shows higher implied volatility. These are measurable signals. Let us talk about percentage behavior again. Silver is not like most assets. Silver has a pattern. When gold moves 1%, silver can move 2%. When gold pauses, silver sometimes spikes. When gold corrects, silver often corrects faster. Over decades of data, silver has shown higher beta. That means higher movement per unit of change. During the last 5 major volatility cycles, silver's peak to trough moves averaged between 25% and 60%. Those moves did not happen in one direction only. They happen in waves. Up, down, up, down. Volatility is not a straight line. Now, here's another number. When silver enters a volatility expansion phase, the probability of large intraday swings increases by more than 70% compared to low volatility periods. That means price is more likely to move sharply within a single session. Again, this is not advice, it is observation. Let us talk about the level. Every market has levels. In silver, one level stands out. It is the level where price has reacted multiple times. It is the level where volume spikes. It is the level where both buyers and sellers become active. That is the level smart money watches. Why do they watch it? Because liquidity sits there. Orders sit there. When price reaches that zone, decisions happen. Either buyers defend or sellers push back. Either way, reaction happens. Reaction creates movement. Movement creates volatility. Data shows that when silver tests a major level after a volatility expansion, one of 2 things happens. Either the level holds and price returns to the middle of the range, or the level breaks and price accelerates toward the next zone. There is no guarantee which outcome occurs, but the reaction itself provides information. Now let us look at volume data. During recent volatility spikes, trading volume increased significantly. High volume during volatility means participation is rising. More traders are entering, more traders are exiting, more orders are being placed. That increases speed, that increases range. In the futures market, open interest has fluctuated. That means positions are being added and removed quickly. Rapid changes in open interest often coincide with volatile phases. Traders are not sitting still. They are adjusting. They are reacting. Options data also tells a story. Implied volatility in silver options has risen compared to earlier calm periods. When implied volatility rises, it means the market expects larger moves. It does not say up or down. It says larger. Now let us bring in correlation data. Silver and gold often move together, but not always at the same speed. Over the last decade, silver's volatility has averaged roughly 1.7 times that of gold. When gold moves slowly, silver often accelerates. When gold consolidates, silver can become unstable. That is what we are seeing now. Gold is steady, silver is not steady. Another number. During previous cycles, when central bank rate expectations changed, silver's weekly volatility increased by up to 35%. Macro uncertainty drives movement, inflation data, interest rate signals, currency shifts. Each of these can trigger reactions. Silver reacts quickly because of its market structure. Now, let us discuss the range. Silver is currently trading within a wide range compared to earlier months. The distance between recent highs and recent lows is large. When a market trades within a wide range, traders focus on boundaries. Top boundary, bottom boundary, midpoint. Each boundary becomes a reference. The midpoint is important. The midpoint is where price often returns after testing extremes. When price holds above the midpoint, some participants view that as strength. When price drops below, some view that as weakness. These interpretations vary. The data is simple. Price moves between zones. Another statistic. During volatile periods, silver tends to retest key levels multiple times before making a sustained move. Retests are common, false breakouts are common, quick reversals are common. That is why volatility is both opportunity and risk. Again, not advice, only observation. Let us talk about the dollar. Silver often has an inverse relationship with the US dollar. When the dollar strengthens, metals sometimes face pressure. When the dollar weakens, metals sometimes gain support. This relationship is not perfect, but it exists. Recently, currency fluctuations have added to silver's movement. Each currency shift can create a reaction. Now, industrial demand. Silver is not only a store of value, it is also used in technology, solar energy, and manufacturing. Long-term demand from these sectors supports interest in silver, but short-term volatility is usually driven by trading flows rather than physical demand. Daily swings are about positioning and liquidity. Let us return to percentages. Over the last several years, when silver volatility increased beyond a certain threshold, average weekly swings exceeded 8%. That is large for a commodity. That level of movement attracts attention. Attention brings more traders. More traders bring more volume. More volume brings more volatility. Another data point. In high volatility phases, the time between major highs and major lows becomes shorter. Moves that once took months can happen in weeks. Moves that took weeks can happen in days. Speed increases, reaction time decreases. Now, let me repeat something clearly. I am not telling you to invest. I'm not telling you to trade. I'm not giving you instructions. I'm presenting data. Markets are uncertain. Volatility increases uncertainty. Every participant must decide their own approach. Back to the key level. This level has seen repeated reactions. Each time price approaches, volume increases. Each time price leaves, momentum follows. That is why it matters. Not because it predicts the future, but because it reveals behavior. Institutional traders watch behavior. They track where liquidity sits. They track where stops cluster. They track where large orders might enter. When price approaches these areas, they observe. Observation comes first. Action comes later. Another number. During the last volatility expansion phase in silver, price tested the same major level 4 times before making a sustained move. Multiple tests weaken or strengthen a level depending on outcome. If the level holds each time, it becomes stronger. If it eventually breaks, the move can be sharp. Now, let us discuss risk metrics. Standard deviation in silver price movement has increased. That means price is deviating more from its average. Higher deviation equals higher volatility. Traders who measure risk often adjust when deviation rises. Again, not advice, only data. Liquidity data shows that order book depth becomes thinner during fast moves. Thin liquidity means price can jump quickly. That is why you sometimes see sudden spikes. There are fewer orders to absorb large trades. Another statistic. During volatile weeks, silver's intraday reversal probability increases. That means price is more likely to change direction within the same session. Strong move up, then pullback. Strong drop, then bounce. This pattern is visible in many volatile markets. Let us talk about sentiment. Sentiment indicators show mixed positioning. Some traders are bullish, some are cautious. Mixed sentiment often leads to sideways volatility. Clear sentiment often leads to trending moves. Right now, sentiment is not one-sided. That creates uncertainty. Now, let us focus again on the phrase smart money. Smart money is not magic. It is simply capital that moves with discipline and data. These participants watch levels because levels attract orders. Orders create movement. Movement creates opportunity and risk. When price approaches the key level, watch reaction speed. Watch volume. Watch whether price holds or rejects. Reaction tells a story, not a guarantee. A story. Another percentage. Historically, when silver breaks a major resistance level after multiple tests, follow-through moves have averaged between 12% and 25%. When silver fails at resistance after multiple tests, pullbacks have averaged between 8% and 18%. These are historical patterns, not promises. Now let me say it again. I'm not telling you to invest. I'm not telling you to buy. I'm not telling you to sell. I'm presenting data, only data. Silver volatility is rising. Daily ranges are expanding. Volume is increasing. Key levels are being tested. Macro uncertainty remains. Institutional and retail participants are watching the same zones. The difference is not information. The difference is execution and risk control. The market does not move because of one person. It moves because of collective action. Buyers, sellers, liquidity, news, data, all interacting. If volatility continues, expect more tests of key levels. Expect fast moves, expect reversals, expect uncertainty. That is what volatile markets do. So what matters now? The level, the reaction, the data, not opinions, not predictions. Reaction to levels tells you more than headlines. Silver volatility has exploded. That is measurable. Smart money is watching the level. That is observable. What happens next will be decided by the market itself. And again, for clarity, I'm not telling you to invest. I'm not telling you to trade. I'm presenting data so you can observe what the market is doing. Nothing more. AG out and about.